Charles T. Munger once said, "Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result." Which is why in this video, I'm sharing with you 6 dividend paying companies that over the last 5 years on average have a return on capital employed of over 20%, which means that they've been using shareholders' money incredibly well. And SimplySafeDividends.com believes that these dividend paying companies are also undervalued. But we love to look for stocks that we think are undervalued and are going to grow. But as the great Yogi Berra said, it's tough to make predictions, especially about the future. So this is not investment advice. This is just for fun and entertainment because I'm a welder that's sharing some information with you, but I'm also passionate about passive income, and we are over 90% of the way to being net worth millionaires. And if you do want to see what this welder is buying and investing on, click the link below, follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. Now, when I put this list together last night, all 6 companies were undervalued, and as of tonight, this recording, you only got 3 that are undervalued as according to Simply Safe Dividends, but the first 3 we're going to look at are right on the cusp of undervalued and reasonably valued. So, let's dive in. First up, with a 5-year return on capital employed of 28.7% is A.O. Smith, ticker AOS. A.O. Smith makes water heaters and water treatment systems. They're the #1 water heater company in North America with 37% of the home market and 54% of the commercial market. And since water heaters last 8 to 12 years, it's a very steady replacement business. Now, AOS is a Dividend Aristocrat with 32 consecutive years of dividend increases. They have a strong market share and just bought Pureit from Unilever to expand their water treatment business. So a few key challenges are about 20% of their sales come from China, where the economy has been slowing down. And North American water heater sales were also soft in late 2024, though that's likely temporary. But imagine your life without hot water on command. These are essential products that people have to replace, which creates predictable cash flow, and a 37% payout ratio and market leadership position should support their continued dividend growth even during tough times. Simply Safe Dividends gives them their highest dividend safety score of 99, very safe. And by the way, you can check out Simply Safe Dividends for absolutely free by just putting in your email address. You don't even got to give these guys your credit card or anything to try it out for 2 weeks. And again, when I put this video together, they were undervalued toward the higher end, so they are reasonably valued now. Simply Safe expects them to have a price range of $70 to $85. And on April 15th, 2025, Simply Safe, their team reaffirmed their dividend safety score of 99 and said that their long-term outlook remains resilient amid the trade tensions. A.O. Smith has a dividend growth streak of 32 years that they've increased it without a reduction, and they last raised it 6.3% in October of 2024, so we've got another dividend raise right around the corner. And as of this recording, they're paying $1.36 annually, which equates to 34 cents a share. Simply Safe Dividends gives them a valuation by taking the 5-year average price to earnings ratio, and with that 5-year look back average, they go 10% above that and 10% below that, which is this gray shaded area. And their whole thought is that if the stock price is above it, it's probably a little bit expensive. You want to wait because the price is going to come down. But if it is below the gray shaded area, it's likely going to eventually come back up. So it could be a good time to buy. So currently they think it is reasonably valued, right on the cusp of that undervalued and reasonably valued area. And it's nice to see the dividend yield above the 5-year average and the forward price to earnings ratio below. When you see that 18.2, it means that you're paying $18.20 for every $1 of AOS's earnings. Now, it should be big enough for you to see, so we won't go 2x2. We'll do the 4x4 here. You can always blow up your phone, right, if you need to. But you see the 10-year trend, and this is what makes Simply Safe really nice. It gives you a good flavor of any kind of cyclicality, where things are. So the free cash flow payout ratio, again, still pretty low, expected to be 34% the next year. And personally, I like to look at free cash flow payout ratio better than the earnings payout ratio, because that is what the dividend actually comes from, is the free cash flow. And you generally want to see, when we look at these, a free cash flow per share, almost any of these margins, unless they are debt, you want to see that coming down. But you generally want to see an upward trend. And of course, with companies like A.O. Smith, there's going to be cyclicality in there, where you see in 2017, 2022, they had free cash flow drops. So they always recover from that, and I would expect that trend to continue. So you see there's some cyclicality. They go from negative sales growth all the way to mid to low 20% range. They have been buying back shares down to 146 million. That's a really good sign. And generally, total sales are up and to the right, although it has stalled out a little bit. So that's something to keep an eye on. It hasn't really gone up all that much since 2022. Return on shareholders' equity of those dollars invested by the shareholders, what has that return been looking like? Pretty high. Pretty high margins all across the board for A.O. Smith. Return on invested capital, how are they investing from the debt and equity? So a 25% margin is really high. We won't do this for every company, just a little flavor. The operating margin is also called the EBIT, the earnings before interest and taxes after they've made sales, currently 18%. Free cash flow margin, every dollar in sales that comes in, how much is making its way down to free cash flow? Currently 11 cents out of every dollar. And remember, with free cash flow, you can pay a dividend, carry it as cash on the balance sheet, invest in other companies, mergers, acquisitions, reinvest in the business, pay down debt, and also buy back shares. And AOS is showing very low net debt of only 5% of their capital structure. And one more explanation for you, the ICR, the interest coverage ratio. How many dollars of operating income, or EBIT, earnings before interest and taxes, does a company have to cover every $1 of interest on the debt? Currently, they're smoking it. AOS has $80.10 of operating income to pay easily every $1 of interest on the debt. So debt is not an issue for A.O. Smith right now. Next is the Donaldson Company, ticker DCI, with a ROST of 25%. So Donaldson makes filters. Think air filters for trucks, factories, and medical equipment. It's pretty much a razor and blade business where they sell equipment first, then 65% of their revenue comes from replacement filters that need to be changed regularly. They have 30 straight years of dividend increases. They just raised their dividend by 11%, and they operate in 140 locations worldwide. And their aerospace and defense business is growing at a rate of mid 20%. Some of their challenges are truck production is down to the low 20%, and the agriculture and mining sectors are currently weak. However, people still need to replace filters even when times are tough, which makes Donaldson a stable and very boring business with recurring revenue and a low payout ratio that should keep their dividend increases coming. Donaldson, ticker DCI from Simply Safe, gets a dividend safety score of 94, very safe. And they too, I swear, were undervalued when I put this list together last night. I think I told you they had 30 straight years of dividend growth. Well, newsflash, it's even better. I guess sometimes 8s can look like zeros, but they have a 38-year dividend growth streak, and they last raised that dividend 11% in May of 2025. Donaldson's hitting you with $1.20 of dividends per year per share, and that's 30 cents every quarter. So they are reasonably valued with an expected price of $70 to $86. If you're looking for something cheap, it's always nice to see the dividend yield, again, above the 5-year average, like it is here for Donaldson, and the forward PE below the 5-year average, where they're currently at 18.2 for the PE, and that dividend yield is 1.69, which is just above the 1.54 5-year average. It's nice to see that Donaldson's free cash flow payout ratio has been coming down, expected to be only 33% in the next 12 months, and free cash flow per share is also down from the previous couple years, but it's expected to jump in the next 12 months to a record high of $3.60 per share. As of late, their sales growth has been in the low single digits. Shares outstanding slowly decreasing. We're at 139 million in 2015, now at 122 million. And their total sales keep going up and to the right, which is nice. You always want to see that money coming in the door increasing. It just makes life easier for these companies. They have very healthy margins. That free cash flow margin has dropped a little bit, so we'll see if that comes back up in the near future. Net debt has been coming down. Look at that, 44% of their capital structure was debt in 2015, and it's currently jumped up a little bit from 20% to 27%, but that's still pretty low. And their interest coverage, $25.20 of operating income to, again, easily cover every $1 of interest on the debt. And that's so important because if you can't pay the interest on the debt, the dividend's getting cut and the company is in big financial trouble and will probably have to take on more debt or issue shares. It's not good. You want to see that interest coverage ratio like at 5, above 8 is what Simply Safe recommends is a good area to give you some of that wiggle room in case they hit some cyclicality. You know them, you love them. Alphabet, or Google, ticker GOOGL, has a return on capital employed of 28.2%. So you know the search giant Google. They also own YouTube, Google Cloud for businesses, and services like Gmail. And about 77% of their revenue comes from advertising across all their platforms. And they're absolutely crushing it with $90.2 billion in revenue the last quarter, which is up 12%. They just started paying dividends for the first time in 2024. It's only 84 cents per year, but that's just 9% of their profits, so they have lots of room to grow. Now, some of their challenges are that the government is trying to break them up over antitrust concerns, but they could be worth more as several separate companies than the whole thing put together, like Voltron. They're spending heavily on AI, which was about $17 billion last quarter, because new AI search engines like ChatGPT could threaten their search business, but they have massive cash generation, and a tiny dividend payout ratio means huge dividend growth potential if you believe Google stays dominant in search and AI. Interestingly, they get a dividend safety score of 80 safe. Look at their credit rating, AA+, very strong. And again, they are just crossing the cusp into reasonably valued. So if you're one of these people that wants to take this as gospel, wait till they get back into the 170s, if they do, and maybe you want to buy there. You see, they just started paying that dividend in June of 2024. The annual payout is 84 cents per share, which is 21 cents per quarter, because that's what 84 divided by 4 is. 21. I'm so smart. Their valuation, again, expected price of $183 to $224 based on the 5-year average trailing price to earnings ratio. So that dividend yield, we don't have a 5-year average, but it's just in line with where it's been. But the PE, the forward PE, is 19.7, which is a little bit below the 5-year average of 21.9. Yeah, really low free cash flow and earnings payout ratios. Earnings per share, free cash flow per share, nicely up and to the right. No negative sales growth going back 10 years. Look at 2021, 41%, but it's come down a little bit, but still a sales growth in the mid-teens is still really good for this big company. And their sales just every single year stair-stepping up and to the right, and they are down now to $12.4 billion shares outstanding, where they were at 13.9 billion in 2015. Just knocking the cover off the ball with all of their margins. Free cash flow margin of, it's not Visa nice, but a free cash flow margin of 21%. And they have such a fantastically clean balance sheet, a net debt to capital of 0. They have no net debt. And they have an interest coverage ratio, $574 of operating income to just stupidly easily cover every $1 of interest on the debt. Debt is not even a remote concern for Google right now. And honestly, I do keep looking at them. I'm debating on it because they are such a big part of my portfolio already, owning a lot of the S&P 500 or the total US stock market through VTI, that I own a good chunk of them. But if they drop again into the 160s or 150s, it might be time to buy, because I don't think they're going anywhere. And again, if they do get broken up, I think like Voltron, I think some of those companies as standalone entities are going to be worth all put together more than Google is right now. Now we go shopping at Ross Stores, ticker ROST, with a ROS of 24.1%. And if you don't know, Ross is America's largest off-price retailer. They buy excess inventory from manufacturers at deep discounts and sell name brand clothes and home goods for 20 to 60% less than regular stores, and you can think of it as treasure hunting for deals. They have a strong business with over 2,100 stores, and they're planning to grow to 2,900 Ross stores plus 700 Double D's, I think it's DD's discounts locations, and they just raised their dividend 10% and bought back over $1 billion in stock. Some of the challenges that face Ross are consumer spending has been weak in early 2025, and they don't sell online while a lot of their competitors do. However, their low price model usually does well when money gets tight, and I'd say that they are a solid defensive play with room to grow their dividend thanks to a very low 24% payout ratio. Hey, look at that, I didn't lie. Ross Stores is undervalued. Just barely. They have a dividend safety score of 90, very safe. Their last dividend raise was 10% in March of 2025, and they did have a very nice dividend growth streak going until they cut that dividend in 2020 pretty significantly, but it was a black swan event, and you have to kind of give companies a pass for that when they legally couldn't have their stores open for a while there. So dark times there were, but it looks like they have recovered, and that dividend is well above where it was pre-pandemic. Ross Stores paying $1.62 per share per year, which is 40.5 cents per quarter. Based on that 5-year average price to earnings ratio, they are currently below that 10% above and below shaded area. So they have an expected price of $131 to $161, and they're currently at $130.48, which is just barely below that $131. Dividend yield of 1.24% is above the 5-year average of 1.07. That PE is a little bit below at 20.4, which again, $20.40 for every $1 of Ross's earnings is what you would pay to buy the company here. Free cash flow payout ratio has been coming down, which is nice to see, although their free cash flow per share is below where it was in 2021, but they are expected to jump to $6.61 of free cash flow per share over the next 12 months. That's what analysts estimate, because like we said, this is an opinion, and Simply Safe Dividends doesn't know the future. If that next 12 months was accurate and spot on for all these companies, that would be a really nice trick from Brian Bollinger and all the fellas and ladies there at Simply Safe Dividends. A little bit of cyclicality there in their sales growth, although it has been dropping. It was 9% in 2024. In the last 12 months, only 2%. So could be facing some headwinds there. So Ross is one to watch. TJ Maxx, ticker TJX, is another that is high on my watch list. Their shares outstanding down to 329 million, where they were at 406 million 10 years ago. And their total sales, other than 2021, have been going up and to the right, where they're at $21.3 billion as of the last 12 months. Nothing to complain about with their margins, 19% return on invested capital. So while not as high as double digits where it had been in the earlier part of the mid-teens, but this looks really nice. Their net debt was 58% in 2016. 58% of their capital structure was debt, and the last 12 months it's down to 18%. So that's really cool to see them repairing the balance sheet, paying down debt, and that interest coverage ratio, because of that, has been climbing, and they're currently at 44.4. Second to last is MSCI Inc., ticker MSCI, with a ROST of a whopping 33.9% over the last 5 years on average. MSCI creates the rule books for investing. When you buy an S&P 500 fund, for instance, MSCI might have created the index that the fund follows, and they receive small fees, approximately 0.02% from the $16.5 trillion in assets that track their indexes worldwide. MSCI has 11 straight dividend increases. They just raised their dividend 12.5%, and they have 98% recurring revenue. And that's because customers almost never leave, because switching index providers is a huge hassle. And a couple key challenges I've found is that their ESG, the environmental ratings business they have, faces political pushback in the United States, which affects about 11% of revenue. And some think that the stock trades at a high valuation, so any disappointment could hurt them. And they're like owning a toll booth on the highway of global investing, which is boring but incredibly profitable with steady dividend growth. So MSCI has a dividend safety score of 61, safe. It's in the lower bucket of that safe rating. MSCI has a 10-year dividend growth streak of consecutive increases, and they grow that dividend really fast. Look at this amazing, stupidly high 10-year dividend growth CAGR of 43%. That is rocket ship level dividend growth. Last 5-year CAGR, we just got to admire this for a minute. This is just dividend growth porn. 21%. And they last raised that dividend 12.5%. So that dividend raise is really far below where it has historically been over the last 5 and 10 years. But come on, almost a 13% dividend raise in January of 25. So there will be another one coming up in about 6 months. MSCI is paying you $7.20 of dividends per share per year, which is $1.80 per share per quarter. And on that trailing 5-year average PE ratio, you can see how sometimes for a few years it was way above that gray shaded area, and then it eventually did come back down, and it's kind of followed the bottom end of it, but we are below that right now, so we don't know when, but eventually it should come back up into that and the price should go up. Dividend yield is a good amount above the 5-year average of 1.02. It's 1.24%, but that forward PE is way below the crazy high 5-year average of 39.1. And if you want to buy MSCI, you got to pay $33.20 for every $1 of their earnings. And I love the earnings payout ratio right here. This is really good. It's mostly flat. As my guy Kevin Burgess, check out his YouTube channel, likes to point out that, and as they say here, a rising payout ratio means the dividend is growing faster than earnings, or that earnings are declining. So you want to see it stable or declining, and it has been stable. Same thing for the free cash flow payout ratio. And just no problems here. Almost every single year, it is just significantly up. Higher and to the right is their free cash flow per share, currently at $20.10 of free cash flow per share. Sales growth is usually in the high single digits to low teens, and they're currently down to 78.5 million shares outstanding, so they have kind of slowed down a little bit, but 2015 they were at 110 million shares outstanding. And those sales just every single year, just up and to the right, higher than the last year. That's really good to see. Now, I wouldn't be too worried about the negative return on equity, because some companies like Starbucks, like MSCI, they buy back so many shares that it actually decreases their book value to where it goes negative, but they're still making money and they're still paying shareholders well. So Return on equity that's negative is not always a bad thing, so you have to look into it a little bit. But all their other margins are just almost Visa-like, super, super high. 47 cents of every dollar coming in the door in sales is making its way to free cash flow, which is just phenomenal. According to this, they have no net debt and currently $8.47, which you would think that should be higher, but hey, okay, they can pretty easily pay the interest on their debt. Lastly, and I've been buying a lot of them as of late, is Zoetis, ticker ZTS, with a ROST of 25.7%. They're the world's largest animal health company. They make medicines and vaccines for pets and farm animals, so when your dog needs shots or a cow gets sick, Zoetis likely made the treatment. 65% of their money comes from pets and 35% from livestock. Zoetis is a growing business. They've raised their dividend for 11 straight years and just increased their 2025 guidance. And their new arthritis drug for dogs, Librela, has seen 80% sales growth. Some challenges that I've found for Zoetis are more competition is coming to the pet medicine market. China's economy is slowing down, which affects some of their international sales, and tariffs are creating some, but not a lot, of headwind. So Zoetis is benefiting from people spending, including me, more on their companion animals. A 32% payout ratio gives them plenty of room for dividend growth as the pet healthcare trend continues. This is a feel-good company that I've been buying a lot more of because they're helping to make sick animals better and to try and keep those animals that are going to be used for food healthy and doing well until we need to consume them for the protein. Dividend safety score of 74 safe, currently pretty undervalued, and I've been riding it down, kind of thinking like Warren Buffett had said that if the stock market were closed or a price didn't exist, if Zoetis was a private company, what would you look at to know if the business was doing well or not? You wouldn't have a stock price, so you look at the business performance, which is what we're going to do here. And for full disclosure, I currently have 71 shares of Zoetis, and we're down 4%. And we have an annual income so far of $142, and our cost per share on average is $156.71. Zoetis has that 11-year dividend growth streak, and they do raise it very, very quickly. A 10-year CAGR of 20%, 21.4 the last 5 years, and they raised it 16% in December of 2024. Zoetis paying $2 of dividends per share per year, which divided by 4 is 50. We're really good at calculations here on the Dapper Dividends YouTube channel. And after spending a few years way above that 5-year average price to earnings ratio, shaded area, the 10% above and below, they've now fallen pretty significantly below it. So I don't know when, but I do plan on holding this for the long term, but we don't know what the future holds. So if some new information comes along, that could change my mind. That dividend yield is pretty high, above the 5-year average of 0.85%. It's at 1.33%. And the forward PE ratio of 23.6 is pretty far below the 5-year average of 32.1 and creeping up on a 52-week low here. The 52-week low was 144 and we're at 150. Their free cash flow payout ratio is still really low. It got to 46% in 2022 because the free cash flow per share took a little bit of a dip, and it's come back up. So 37% over the next 12 months expected. That's still really nice and low. And they're also expected to be at an all-time record of $5.38 of free cash flow per share. 2015 was the last year of no sales growth, and almost every year they have mid to high single digits. Their total sales keep going up and to the right every year, and the shares outstanding slightly decreasing from 502 million in 2015 to 452 million over the last 12 months. And their margins are just swell. 25% free cash flow margin. Right? 25 cents of every dollar coming in the door in sales is making its way to free cash flow, and a return on invested capital of 23%, which looks to be a record high going back 10 years. And some say that another sign of a moat could be an operating margin that is stable and rising, which they have been. So they have 37% of an operating margin, or their earnings before interest and taxes after accounting for the total sales. Their net debt has been coming down. It was almost 80% of the capital structure in 2015, and it's come up a little bit, but we're at 52% right now. But the interest coverage ratio, easily able to cover every $1 of interest on the debt, $15.60 of EBIT, the earnings before interest and taxes, that can cover easily the interest on Zoetis' debt. I think they're a feel-good company. I like what they're doing, and I am intending to hold them for quite a long time. I would love for you to share in the comments below which of these you are buying, or what is your favorite undervalued dividend stock right now, or any stock. I don't care, whatever you want to share. Whenever you're watching this video, share it in the comment below. I'd love to see it, and I'd love to connect with you on Blossom. And also, in this floating little box next to my head, I have some more undervalued, cheap, quality dividend stocks you might be interested in. So if you click that little floating box right next to my head, I'll tell you what they are there.